Augusta rule is one I've talked about very often. It's just simply you can write off your home if you use it for business purposes. Employee retreat, customer retreat, whatever that might be. 14 days a year, you can write it off based upon comparables. Look at Airbnbs, look at hotels. If there's a Super Bowl in town, that's a good time to do it because prices are going to jack up and you can now justify that expense. This literally is my home office, and so a percentage of my house can be written off, including utilities and home office. Let's start philosophically with a few critical components. A, never let the tax tail wag the dog. What I mean by that is never spend $1 to save 37 cents. Let the economics guide you and the taxes follow. When people make tax choices on things they would never do otherwise, it ends up costing them money. See, there's people like, oh, I bought this car. Did you want to buy it? No, but I wanted the tax write-off on Section 179. Well, guess what? The car's probably a depreciating asset, although in today's economy, you never know. But most of the time, it's a depreciating asset, and every time it's driven off the lot, there's quite a bit of expense that comes along with it. So I want to make sure that if you're spending $1, you're saving more than $1. That's going to be part of the framework. The second thing is the best tax advantage, the best tax strategy that anyone could ever use is to always earn another $1. A lot of people get in this place where they're like, oh, I'm going to get killed with taxes. I don't want to pay too much in tax. And we have to just understand the distinction between an average tax rate and a marginal tax rate. If you make $100,000, just to keep numbers very simple, and you pay $17,000 in tax, that's your average tax rate of 17%. But you paid less than 17% on the first $20,000, $30,000 you earn. Then from $30,000 up to $70,000, you pay a little bit higher rate. It's like a step. And nothing, no matter how much more you make, they never come back to those first dollars and ever tax them more. So that's a marginal rate. When we save tax, we always save off our highest marginal rate. We save tax on the last dollar earned. Our last dollar earned is always our highest taxed dollar. Everything before that comes in the lower marginal rate. So you might be at a 25% marginal rate, but only be at a 17% average. Or you might be at a 37.5% marginal rate, but really only be paying 22% in tax because the first dollars you earned were taxed lower than the later dollars you earned. And I'm just talking about federal income tax right now. So even if the top tax bracket, which in the highest bracket was over 90% at one time in the US, over 90%. And if you earned $100,000 and you had to pay $90,000 of that in tax, you'd still have $10,000 more than if you didn't earn the money. And again, it never hurt the earlier dollars you made. So I don't want to let the tax tail wag the dog or let tax become an impediment to productivity. Think contribution and value first, and then think about what can I do to maximize my tax savings without harming myself. That's the context. Now, this framework I'm giving is really 3 main categories, and that you're going to meet with a tax professional or tax team every 3 months, and then every 3 years, look back and make sure you didn't miss anything, because if there are errors or mistakes, often we can go back and amend the returns and get that money back. So that's why 3 years. So the first bucket is your team. The second bucket is your deductions. And the third bucket is the classification of your income. So let's start with the team. The easiest thing to understand, the hardest thing to implement. Often because we outgrow our accounting teams. Maybe we start with someone that does a good job and we're just starting in business and everything's great, and all of a sudden you jump up and have a higher marginal rate. Or let's say they're just really good. And then they take on too many customers and they find themselves filing taxes a lot more than actually doing strategy. There's a number of reasons here that this can happen, but often people just don't want the switching cost. And there's a lot of excuses that I want us to kind of cut through and understand, are just excuses often. The first one, and the one I despise the most, is I'm conservative. When your accountant tells you they're conservative, let me translate that for you. I've missed tax deductions for you, certainly. And when you catch me, I'm going to tell you I'm conservative because you're afraid and I'm afraid of the IRS. And if we all believe that we're afraid of the IRS, then we'll just overpay taxes because of that fear. I'm here to tell you, I want you to legally and ethically save every single dollar you possibly can. And if you do that in the fair way, we're not talking about aggressive strategies overseas or evasion of taxes. I'm talking about legal avoidance of taxes. And evasion versus avoidance are two separate things. If you're driving in a car and you come up to a toll bridge and you choose not to pay pay the toll, you've evaded the tax of that toll. If you know that there's a bridge 6 blocks down that doesn't charge, that's avoiding that by going down that other bridge. We're only looking at tax avoidance, never tax evasion. That's a clean distinction. And the number one reason people get in trouble in the United States, at least when it comes to taxes, is by not reporting their income. That's what the IRS's number one concern is. Are you choosing not to report all the money that you make? If you get caught not reporting the income, that is one of the more egregious things you could do that puts you at risk. Many people get in this fear of like, well, I don't want to go to jail. I don't want to get into trouble. And if this is a tax advantage that I've never heard of, or my account's never heard of, it must be because it's something wrong. But look, we can go in every different profession, and there's so many things that we don't learn about until later on. Anyone that's an entrepreneur goes, oh man, I wish I would have known this 10 years ago or 5 years ago. And this is just what happens in the world of tax, because I don't know anyone that just wants to sit down and read the tax code. It is dry, it is boring, it is changing, it feels complicated. But it's the same thing when I read legal contracts. I don't even know what the legalese half the time is, and that's why I pay attorneys to help me understand and read between the lines of legalese. It's the same reason I pay for great accounting and great tax strategy. I need someone that can really understand what's being said there in a clear and clean way so I can avoid the taxes, never evading them. So the team is important because there's up to 4 people on the team, depending on where you're at in life and the level of complexity you're facing. The one that's important for everyone is simply the first person on the team is either a bookkeeper, a controller, or a CFO, or for someone of the right size, all 3. A CFO is for a substantial entrepreneur and business owner that needs pro formas and projections, and they need their margins looked at, and they need to really understand all their numbers. That's going to be a little bit more advanced. A controller is making payroll, and they have that type of responsibility, where a bookkeeper is simply, here's the data that's coming in, we're accounting for that so that you have timely numbers. People that aren't timely with their data tip the government because they wait until the next year, and most of your tax advantages occurred during the year that you're earning, not the year that you're paying the tax, because you pay tax the year after. And when most people wait till the year after, they've missed so many opportunities to save tax, and most of the opportunities that come the year after are merely tax deferral, not tax deductions. Deferral says I'm not paying tax today, but when I benefit from it in the future, I have to pay tax then. And there's this misnomer of, oh, you'll be in a lower tax bracket in the future. You better hope that you're not, because there's only 2 ways to get there. Number 1, you make less money. And I don't know about you, but I'm not excited about making less money in the future, because imagine the people that were going to retire in the year 2021. You know what? I'm going to retire off 70% of my income because I'm just not going to need all that. And then they find out inflation decimated their savings. And so that 70% wasn't adequate. It wasn't nearly enough. And now what are they going to do? So this notion of having less money in the future is a problematic thinking process, typically given because people are underprepared and underwhelmed with their financial house being in order. And now they're looking for that excuse. The second thing is, I guess the government would have to lower taxes. And you know what? If you sell your business, you have less tax deductions at the time that you sell your business. And if you retire after that sell, you're probably paying more tax per dollar than when you had the convenience of having this major tax write-off called a business. So the government's $33 trillion in debt. If they lower taxes, how are they going to pay off or stop that from growing? I think it's a concern to think that they're going to lower tax brackets, or it's a concern to try to have less money in the future than you have today, because here's the deal. Inflation by itself pushes up our marginal rates. We have to make more money to buy the same things, which means we have a higher tax rate as we have to make more money, even though those dollars are worth less. I'm going to repeat that because it's a very important point. Inflation requires that we have more money to buy the same things. When things used to cost $1, they cost $5 today, 30 years later. We have to make more money to buy that same thing, which pushes us in a higher tax rate, which means for every dollar we earn, a higher percentage is going to the government, meaning we have to earn even more than we thought to battle inflation to deal with this tax problem. So don't try to have less money in the future unless for some reason that's 100% tax-free money. Having detailed data and having it timely matters, and taking tax deductions instead of deferrals matters. The second person on the team is a tax strategist. A tax strategist's job is to help you navigate the tax code to maximize the second bucket, which is tax deductions. Now, I want someone that's going to proactively help me navigate that. Often, we have CPAs that are historians and not strategists because they're paid based upon the number of taxes they file, and it marginalizes them and they become commoditized. And when they become more about filing than strategy, you now have a historian, not a strategist. Sometimes strategists strategists don't even file taxes. They might be a CPA or an enrolled agent. They might be the design, and then they have people that do the filings based upon their findings. You want someone that you talk to and proactively navigate and say, how can we maximize deductions? We'll go more into that in the second bucket. The third person on the team is an attorney. Now, for some, it might just be a corporate attorney. If you're a business owner, having a corporation matters massively for your taxes. Whether you're an LLC and how you tax that, an S Corp or a C Corp can be different in how you pay your taxes. One is an LLC and S Corp is a pass-through entity. They both mean that you have to pay taxes whether you take the money out of the company or not on your personal income taxes. A C Corp can allow you to retain earnings though, but you pay corporate tax on the way in. So which corporation you choose matters. So having an attorney that understands that's important, because I've seen accountants sometimes say you don't need to incorporate. Well, number one, you need to incorporate because you have unlimited liability when you're unincorporated. Number two, I've been told multiple times by people that are in the accounting field that you're 400% higher chance of being audited as a sole proprietor than being incorporated. So that alone is an important factor. The unlimited liability is an important factor, and the fact that you might be able to reduce taxes, which we'll talk about in the third bucket, called reclassification, based upon the entity you structure. So everyone that's in business should look at having a company. But the second thing is, as you make seven figures, as you get into a place where you have a lot more income, now you want to look at a tax attorney, not just a corporate attorney. And that tax attorney is really responsible for that third category of reclassification, just like the corporate attorney might be. So the first thing is bookkeeper, controller, or CFO, tracking the data and helping you make sense of the numbers. The tax strategist might be a CPA or an enrolled agent, or just someone that's really proactive with you, then the attorney. And the fourth one is really for those people that own commercial property. So commercial property means you can accelerate your depreciation through something called cost segregation, and an engineer would do the cost segregation study and give that report to your accounting team. So that allows you to kind of collapse and start getting more tax advantages, because carpet wears out. You have to repaint the walls. You have things that you replace inside the building, and if you don't, it could take up to 39 years to get that tax benefit for depreciation purpose. So the team is the first category. The second category is deductions. And deductions matter when you own a business. Deductions aren't really as beneficial or useful when you're not a business owner. Sure, deductions when you're charitable, those count, but business owners have a lot more deductions than non-business owners. So if you're a business owner, you just look and say, number one, I have income that's coming in. Does it relate to my business? That's the first question. And if it does, you automatically deduct that by making sure you have a documented system. If you're not sure, you might say, I don't know if this really relates to my business, or if it could relate to my business. It kind of does, because there was some business that happened on this trip, but it wasn't really completely a business trip. Well, that's when you have that conversation once a quarter with your tax team and say, look, we're taking this trip. What if we did our annual meetings during that trip for corporate compliance? What if one of the days of the trip, we actually had a mastermind with our employees or customer? Like, you might find ways that give you more excuse to write off part of that trip, but that's why you have this quarterly meeting with your tax team to proactively navigate that. So number one, does it relate to the business? Number two, if so, you document it. And if you're not sure, you put it in a category where you're like, we're going to talk about it once a quarter and either reimburse it because it's deductible, or it just was a personal expense. Now, there's so many deductions for business owners. I'm going to give a sampling of those deductions. Augusta rule is one I've talked about very often. It's just simply you can write off your home if you use it for business purposes. Employee retreat, customer retreat, whatever that might be. 14 days a year, you can write it off based upon comparables. Look at Airbnbs, look at hotels. If there's a Super Bowl in town, that's a good time to do it because prices are going to jack up and you can now justify that expense. Another one would be employee retention credits. If you had any impact where COVID impacted you for a day, an hour, a week, a year, well, you actually can have credits up to $26,000, $27,000 per employee over 2 years that come back to you. R&D credits. Have you modified a CRM? Have you built an app? Have you built a website? Did you use people inside of the United States? These are credits above and beyond the expense if you did that inside of the United States. And by the way, you can go back 3 years and amend your returns if you miss those credits. So R&D credits, employee retention credits. One that just depends, are you in the medical field or whatever, you might be excluded, is Section 199A. 199A is a pass-through deduction that says, hey, if you have employees and they're W-2 employees, you might be able to lower your tax rate because of this 199A deduction. There's two different categories of how it happens. It's beyond what we would talk about just in a video like this, but ultimately, that's something to have a conversation with your tax team and say, could I qualify? They might say, well, you're a dentist and there's an exclusion. I don't understand why they would exclude dentists who went to school, got bigger student loans. If anything, they deserve it even more, right? A doctor going through this, but but you might have different parts of your business for TMJ or sleep apnea that might be different, that if you categorize, you might be able to take 199A on. So you might just have to have more than one company to make that happen. So it's something that's a conversation that would need to occur. Section 199A, R&D credits, employee retention credits, corporate compliance, meaning that annual trip is important, and you can write that trip off because you need to, any entity you have requires annual minutes for it to remain a company and not have a corporate veil pierce. So I like to travel for that. That's a good excuse. And I just time and date stamp something in Evernote showing these are the notes, and I send them to my attorney. So pretty simple, but that's a write-off. 132J, directly below me right now is a swimming pool. I've got a cold plunge, and I've never posted a video on a cold plunge, which is nearly a miracle because everyone has a cold plunge, has to show you them in the cold plunge and how they're able to handle it. I talk about it, so I'm almost as bad. But you know, I've got a hot tub, I've got a swimming pool, and I've got a gym. 132J for one of my companies that happens to only employ my family. I can write off the management of that. So the pool people that come and all the maintenance that goes along with that. I've got home office deduction because I sold my company, and this literally is my home office, and so a percentage of my house can be written off, including utilities and home office. So these are just a few of the deductions that are available. I don't think the deductions are the game changer, because if you deduct too much, then you can't go get a loan. If you write off everything that you ever do, it can harm you on other areas. Hey, thanks for watching. I appreciate it. And if you're enjoying these videos, well, there's good news. More where that came from, so go ahead and click through and watch the next video now.